Thank you, Stefano. And again, it's a pleasure to be here today, and thank you to Bocconi for hosting this. I would like to spend a few minutes talking about the backdrop of really why finding a growth path for Europe is so important, and why infrastructure is a very crucial conduit to generating some growth. So let me just start with a few basic points. First of all, if you look at the overall Eurozone economy, the level of real GDP, that's the dark line here, has stagnated now already for a number of years. In fact, it's around 2% below the level it peaked at in 2007. And if you look at the trend, or the previous trend of growth in the Eurozone, the light blue line, you can see there's a very big output gap that has been created. Growth is well below its potential, its productive potential, and it's important to find a way of releasing that potential growth. Of course, and as Dario mentioned, this is an aggregate, really, because there are big differences across the euro area. If you look at this chart, it's showing the same picture for the level of real GDP for the big four Eurozone economies. Germany is already above its previous peak, and growth is accelerating, whereas, for example, in Spain and in Italy, growth is pretty much back to its previous trough and is broadly stagnating. So there are big, and if not increasing, divergences in the underlying picture of growth across these various Eurozone economies. And part of the reason for this divergence is the policy setting. If you look at the fiscal drag on GDP in some of the main countries, particularly for this year and for next year, they are quite significant. So reducing, for example, GDP growth by around 1.5% over the course of this year. In Italy, nearly the same again next year, and the picture is similar for Spain. Furthermore, if you look at the monetary policy setting within the single currency, and we look here at a model of what we call financial conditions, which take into account short rates, long rates, credit spreads, and so on, policy is actually being loosened for Germany, which needs it least, but is being tightened for countries like Spain and Italy, which need looser policy, not tighter policy. So again, the framework that the Eurozone finds itself in is actually exacerbating the differences and making a path for growth increasingly important. And as we know, there are big differences in the competitive backdrop within the Eurozone. This chart is looking at unit labour costs across the Eurozone going back over the last decade. So this is a measure of productivity-adjusted wages. In the case of Germany, having been the most expensive place to really produce goods in Europe for the previous decade or so, over the last 10 years, unit labour costs have remained pretty much unchanged, while at the same time they have increased dramatically in other Eurozone countries. And of course, within a fixed exchange rate system, these competitive differences can't be adjusted through the external exchange rate, and therefore need to be adjusted through domestic relative prices and wages, which is putting further downward pressure on growth in some countries. And we've already seen pretty much a similar chart from Dario showing that in aggregate terms, the constraints of debt in Europe, while are big, are not as big as they are in many other parts of the world. And this is just showing the stock of debt to GDP across the Eurozone compared to other regions. And this is true when we look at budget deficits as well. So in a sense here, the problem is a political rather than an economic one, and it requires imagination and other supports to help this period of stagnation and to stimulate some growth. When it comes to capital spending, gross fixed capital formation, or investment spending as a share of government expenditure, the only country in the Eurozone where we saw a big increase over the course of the last decade was in Spain, which saw a dramatic boom in fixed investment spending, although most of this was on construction. But all of the European countries are seeing a contraction as a share of government spending over the course of the last 3 years or so, during which the financial crisis has manifested itself in the Eurozone very strikingly. But using fiscal policy to help support investment spending and growth is likely to be an increasingly important policy objective. This chart is looking at the impact of a 1% spending change in terms of the 4-quarter impact on GDP for economies in different underlying conditions. So if you look at countries, for example, that have a negative output gap, in other words, they're growing well below their economic potential, which is the case across the Eurozone, a 1% positive spending shock has a multiplier of nearly 1.5 times a significant positive, whereas, of course, a 1% negative spending shock for countries that have a big output gap is almost as negative by the same multiplier. And that's one of the reasons why pure austerity in an environment where you have big output gaps is not likely to create the required growth to bring about a reduction in deficits. Now, while we have this rather difficult backdrop in terms of the policy setting and the economic conditions in Europe, there is a potential for more spending coming through, of course, from the private sector, because unlike the government sectors, the corporate sector has very good balance sheets, and this is true in most parts of the world, certainly true here in the Eurozone. So if you look, for example, at this chart, you'll see that the share of cash on balance sheets is pretty much at a record high on both sides of the Atlantic. So companies have got very strong balance sheets. They are storing cash. Much of this is for precautionary reasons, because companies are unwilling to spend because they don't know what the economic outcome is going to be. They're also unwilling to spend cash because they're worried about the ability to get financing in the future from banks who are aggressively deleveraging. And so there's a lot of precautionary cash built up in the corporate balance sheet of the Eurozone economy. Also, what we're finding is that companies themselves are not expected to really change their investment plans very much moving forwards. What we've done here is to take investment analysts' expectations of investment spending for all the companies in the Eurozone and split it into bands of expected growth. And what you find is that the vast majority of companies in Europe are expected to see either a contraction of investment spending moving forwards or pretty much no change. Very, very few companies are expected to actually increase their investment at the moment. And again, this comes back to the uncertainty that there is in the corporate sector because of the macroeconomic environments, and also the negative feedback loop as banks themselves continue to delever, reducing the funding opportunities for the corporate sector to borrow to finance investment. At the same time, there is a big need to invest, and this would be true even without the current financial crisis in the Eurozone. This analysis that we've done, shows that those companies that are European and are investing are increasingly investing outside of the Eurozone. So this is taking companies in the quoted corporate sector across Europe and looking at the percentage or the proportion of their investment that is going into the Asian region, for example, and overall in emerging markets. So year by year, not only are companies spending less, but where they are spending money, it's leaking out of the Eurozone and increasingly going to those parts of the world that are seen to drive stronger growth moving forwards. Meanwhile, if you look in the Eurozone itself, the average age of assets has increased to record highs, increasing the imperative to increase investment and create new, more productive investments. So where are the investment opportunities? Well, of course, there are a great deal. If you look across the different European countries, you can see here infrastructure spend as a share of GDP over the period from the mid-1990s to 2005, and then again from 2006 onwards. Spain was the only one that dramatically increased investment, as we've already heard. Many of the other countries have actually had relatively low investment spend over that period of time. And you can see here the split of investment spend between the various sectors, transport, telecommunications, energy, and other. The vast proportion in most countries that we've seen investment spending in so far has been in transport, but there's a big opportunity, I think, in these other sectors. Finally, I think just again to make some comparisons of different sectors. I hope you can see this from where you're sitting. We're just looking at, for example, power, infrastructure, the amount of power being developed in each country, broadband, speed and facilities in each country, and air transportation. And in virtually every case, Europe falls dramatically behind global comparisons. And here, for example, you find that Italy, in terms of power generation, is significantly behind other parts of Europe and, of course, the US and some emerging economies. In terms of broadband, average speed, for example, you have countries like South Korea at the top, some of the Scandinavian countries towards the top, and then most of the Eurozone countries down at the bottom, with Italy down here at the bottom of the rankings. And this is similar when you look at air transportation capacity as well. So I think when we look overall, of course, we are in an environment where the macro conditions are very challenging. That's true not just for Europe, but globally. It's especially true for Europe as the political process moves towards building up the necessary infrastructure to provide some path towards a fiscal union. Overall, the Eurozone economy is stagnating, but there are growing differences across the Eurozone. And one of the imperatives to reduce the burden of tightening budgets through austerity is, of course, to increase investment spending. And at the moment, we're finding very little incentive for the private sector to fill in the gap, despite the large pile of cash that the corporate sector in aggregate has built up because of the growing uncertainties that many companies have about future sources of funding and economic conditions. So we think that there are many opportunities to increase spending in infrastructure in Europe. Average age of assets has increased dramatically, so there's a good economic imperative, and hopefully we'll see the opportunities and policy settings to support that growth moving forwards. Thank you.